Everyone, Phil Hodgen here. Welcome to the Hodgen Law PC International Tax Lunch. We do this on the second Friday of every month at noon Pacific time. You can listen in online via CalCPA, which is what you're doing right now, or later it'll get posted to YouTube and you can watch it there. Anyway, this month we're talking about expatriation and one of the critical elements of handling an expatriation project, namely the certification test. There are three tests: the net worth test, the tax liability test, and the certification test when you figure out what's the tax impact of giving up U.S. citizenship or a green card. Our experience is that everybody hand waves off the certification test, and our further experience is almost everybody has their foot in a dog poo somewhere on this thing. So it's an important one. It's boring. Everyone focuses on the net worth test, but this is where the fun and games really happens. So Deborah Rudd, who is a CPA and a member of our team, you can look on our line to see more about her, but she's going to talk about the certification test in depth, and off we go.
Hey everybody. All right, so let's get started. As Phil said, the certification test is the one that people often ignore when looking at the three tests, or not entirely ignore it, but kind of just don't spend much time on it. But my experience with working with this is that there are actually some things to be pretty concerned about here depending on the specifics of your tax situation. You might not have much of a problem, or you might have some pretty big problems. So this presentation is sort of to kind of help navigate through figuring out, do you have a really big problem, and if so, some general ideas on how you might want to approach fixing it. So we're going to talk about the background a little bit. What's expatriation? What does it mean to be a covered expatriate? What does it mean to be a non-covered expatriate? And how the three tests play into that. Then we're also going to spend some time on specifically what is the certification test, what is it that it's asking you to certify, how do you know when you've met the certification test, that kind of thing. Then we'll talk about what to look for, kind of a summary of, things to think about when you're making judgment calls, because ultimately this comes down to judgment calls more than anything else. And then we'll talk about some possible strategies for fixing your tax compliance. And then lastly, if there is time, I have a case study where it's an example of some situations I've worked on, problems that people have had on their tax returns, and how we would recommend approaching fixing a certain fact pattern. So let's get started with the background. So expatriation is what happens when a U.S. citizen terminates their citizenship, or when someone who is a, quote, long-term resident terminates their permanent residency. So we have some terms that we need to define here for this to make sense. Citizen, this one is a pretty easy one. Most people know if they have U.S. citizenship or not, though occasionally they don't know. For this one, you were either born in the U.S. or you were naturalized, but typically people know if they're a U.S. citizen. Long-term resident, this is the more tricky of the two definitions. This one is where you have permanent resident status. In other words, you have a green card, plus you meet a certain time period for having that resident status. So if you're a lawful permanent resident, or you have a green card, in at least 8 years of the 15-year period ending with the expatriation year, then you're a long-term resident. And when they say the word in at least 8 years of the 15-year period, the word in means that you had the green card for any amount of time during that calendar year, even just one day. Now, I've talked to people who have said, oh, I got my green card on June 30th, 2008, so I haven't had it for a year until June 30th, 2009. But no, actually, as of June 30th, 2009, you've had it for 2 years for the purposes of this test, because you've had it in 2008 and in 2009. So you count 2 years for that situation. So that's what it means to be a long-term resident. And expatriation is something that only citizens and long-term residents can do. So if you have a green card in fewer than 8 years and you terminate it, then you won't be an expatriate. You don't have to worry about being covered or non-covered, file the paperwork. That's not going to be an issue for you. If you are in the U.S. on a visa other than a green card and you terminate it, you're also not an expatriate in that case because you must have the green card status to be a long-term resident, and you don't have that, so you can't be an expatriate. Now, the thing that makes you an expatriate is actually terminating the citizenship or the green card. So this can be done by you. This can be done by the government. They can revoke this from you. Or for long-term residents, you can make a treaty election, which if you've had the green card for at least 8 years, that would terminate your long-term resident status at that point. So there's 3 ways, basically, well, 2 ways for citizens, but 3 ways for long-term residents that expatriation can actually happen. And almost always it's going to be an act that the actual taxpayer does. It's usually going to be you giving up your citizenship, you giving up your long-term residency, or your permanent residency. I mean, it's very uncommon for the government to do this for you. Now, a lot of times I've had the question about, okay, my green card expired, so I must have expatriated. That's actually not the case. Citizenship doesn't expire, obviously, but green cards do. And when your green card expires, that actually does not terminate your lawful permanent resident status, so the clock is still ticking on your long-term residency years count at that point. So people who your green card has expired, you have actually not yet expatriated. You actually have to turn in the green card and file Form I-407, or the government takes away the green card, one or the other. But in either case, it doesn't happen when it expires. There has to be some other event that happens, either you turning it in or the government taking it away. So let's say that you are an expatriate, either a citizen or a long-term resident, and this status has been terminated and you've determined that you're an expatriate. The next thing you have to look at is whether you are a covered expatriate or a non-covered expatriate. Covered expatriate is someone who fails any one of 3 tests, and this is what Phil was talking about at the beginning of the presentation. There's the net worth test, the average net tax liability test, and the certification test. And of course, we'll be spending most of our time on the certification test today. So if any one of those 3 tests is not met, then you're a covered expatriate. And then a non-covered expatriate is just an expatriate who's not a covered expatriate, or someone who doesn't fail any of those tests. The first of the tests is the net worth test. And this is if your personal individual net worth is $2 million or more, then you're a covered expatriate. Second one is, and that's as of the date of your expatriation. Second one is the average net tax liability test. This number actually changes every year, but let's say you're expatriating in 2018. You would look at the 5 prior tax years, so 17, 16, 15, 14, 13, those 5 years. And if the average of your tax liability over those 5 years is $165,000 or more, then that would make you a covered expatriate. And this one applies if you have a jointly filed return, you take the total tax liability for this, you don't split it in half. Lastly, the one we'll be covering today is the certification test. And this was where the government checks for, do you have full tax compliance for the last 5 years? In other words, have you paid all your taxes? Have you reported all your income accurately? Have you filed all your information returns? Have you complied with other types of tax, like gift tax, employment taxes, things like that? And if you can say yes to this and you meet the other two tests, then you won't be a covered expatriate. But if you fail any one of these three, including the certification test, that makes you a covered expatriate. There's a couple exceptions to these tests, and you basically get to ignore the net worth test and the net tax liability test if you meet one of these exceptions. One is if you're born a dual citizen, and there's some other criteria to both of these. The dual citizen one, I think you have to be a resident of another country for a certain time period as well. But the basic concept is if you're born a dual citizen or if you're under 18 and a half years old at your expatriation date, you get to ignore those first two tests, the net worth and the net tax liability test, and all you have to do is meet the certification test. If you do not meet the certification test, even if you meet one of these exceptions, then you'll be covered expatriate. So there's actually a flow chart here on slide 15 that I find really helpful, and it kind of shows how you figure out, you're starting in the orange circle in the upper left-hand corner as an expatriate, and you go through this flow chart and you answer the questions, and at the end you either end up not a covered expatriate, the orange box on the orange circle on the right, or you end up a covered expatriate, the red circle on the right. And if you see how we laid this out, the very first thing you do is you go into the gray diamond on the left, and it asks, are your Title 26 obligations okay? And this is another way of saying, have you met the certification test? If you say no, that means the prior 5 years tax obligations not satisfied. You'll see that takes you directly to covered expatriate status. It doesn't matter whether you've met the net worth test, doesn't matter whether you've met the tax liability test. Certification test not met, you're automatically going to be a covered expatriate at that point. We can pretty much skip over the rest of this diagram. It's useful information. I find it helpful in explaining to people, here's how you navigate through figuring out if you're covered or not. But for today's purposes, all you really need to know is certification test not met, covered expatriate. So if you end up being a covered expatriate, the reason that you don't want to be covered, the reason that's bad, is because you would have to pay exit tax. And exit tax is where you pretend that you sold all your worldwide assets, everything you own, your house, all your investments, everything, and then you pay tax on the gains on your U.S. tax return as if you had actually sold all your stuff. And this gets a little tricky, a little ugly, because let's say most of your assets are foreign assets. You won't get to take advantage of things like foreign tax credits because you didn't actually sell your stuff, so you didn't actually pay any foreign tax. So then later when you do sell your stuff in the foreign country, and if you have to pay tax on it, that'll be a bad situation because you already paid U.S. tax on it and no credits. So not great. The other thing that happens when you're a covered expatriate is Section 2801 applies, and this is where U.S. recipients of gifts or inheritances from covered expatriates pay tax at the maximum gift tax rate. Normally, you receive an inheritance, it's going to be tax-free, but if you receive an inheritance from a covered expatriate, that will not be the case. So that's another reason that being a covered expatriate can be bad. All right, so we've got a lot of the background information out of the way, so we can start talking about what is the certification test. Essentially, as much as I can figure out, this is basically a way to try and make sure that people don't use expatriation to escape their tax problems. I've spoken to a number of people over the years who say to me, you know what, things got messed up so badly, can I just terminate my citizenship and move on and just be done? And the answer is, well, kind of, but you probably want to make sure you meet the certification test before you do that. In other words, clean up the prior 5 years of tax returns. So it's not really that you're able to use expatriation to escape your tax problems, because the certification test makes sure that you fix the prior 5 years before you terminate your U.S. Citizenship or permanent residency. And this is what you actually answer on Form 8854. It says, do you certify, under penalties of perjury, that you have complied with all of your tax obligations for the 5 preceding tax years? And then it refers you to the instructions. And the instructions just basically tell you you have to have reported all your income tax, filed information returns, paid all your taxes, and if you didn't do that, then you're covered, and basically just summarizes what we've been talking about already. The way this is written, if you think about this for a minute, think about what it would actually feel like to check the no box on this. Personally, I think you would be opening yourself up to audit for the 5 prior tax years and telling the government, hey, I definitely messed up my tax returns and you should go look at that and come after me for that. So personally, I would not be wanting to check no on this in any case ever. And actually, I have never prepared a return for a client where we checked no. We always, if there were issues that needed to be cleaned up, we always clean those up first, and then we say yes on the certification test. So let's look at what the actual law says where the certification test is found. This is section 877A2C, and it says that if you, well, I'll just read the quote. Any expatriate who fails to certify under penalty of perjury that he has met the requirements of this title for the 5 preceding tax years, or fails to submit such evidence of such compliance as the Secretary may require, has failed the certification test. And we'll unpack in a couple minutes what all of these different words mean. But basically, it's telling you you have to meet all the requirements of this title. This title means Title 26. That's the tax code. So you have to comply with all the tax laws, essentially. And if we go and look at the notice, and I use the words the notice to mean Notice 2009-85, this is the only authority from the IRS that exists on expatriation other than Section 877 Cap A and Section 877. There's no regulations to rely on, so we have the notice and we have those 2 code sections. So if you look at what it says under the notice, all U.S. citizens who relinquish their U.S. citizenship and all long-term residents who cease to be lawful permanent residents or green card holders of the United States must file Form 8854 in order to certify, under penalties of perjury, that they have been in compliance with all federal tax laws during the 5 years preceding the year of expatriation. So this is basically reiterating what was said in Section 877, where you have to comply with Title 26, or in other words, everything that's required in the tax code for the 5 years before expatriation. And if you're like me, you're already wondering, so when does this certification have to happen? Is it the date you expatriate? Is it the date you sign and file Form 8854? Because Form 8854 is where you're making this certification. The IRS has taken a position on this, and I'm saying it's a position because this is not covered in the code. This is in the notice. It says the determination as to whether an individual is a covered expatriate is made as of the expatriation date. So that means if you have certification test problems, it's probably a good idea to clean them up before you expatriate. But what about this situation? let's say that you expatriate on January 2nd, 2018. Well, you would have already expatriated, but as of that date, how do you certify full compliance with your 2017 tax obligations? Because at that point, you probably haven't yet filed your 2017 tax return. It's not even due until April at the earliest, probably June if you're living abroad. Definitely June if this is your expatriation year and you're a non-resident at the end of the year. So at this point, all you can certify is that you intend to comply with your 2017 obligations. So what happens if you never file a 2017 tax return? I think at that point, personally, I would take that to mean that you had failed the certification test, because next year, when you're signing your Form 8854, at that point, you can't even certify that your 5 years are correct. But in other words, this is just pointing to a problem with the IRS saying that you have to certify as of the expatriation date, because if the due date to do everything hasn't even passed, how could you possibly certify that? So I'm pointing to a problem here without providing a solution. Don't know the real answer, but it's probably best to do everything you possibly can to pass the certification test prior to expatriation. And then if you expatriate before the due date of a tax return that's covered under the certification test, you should really make sure to file that tax return and make sure it's correct and you pay all your tax. And then lastly, this is another IRS position. This certification must be made on Form 8854 and must be filed by the due date of the taxpayer's federal income tax return, blah, 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 etc. What this seems to be implying is that to pass the certification test, you would have to file your expatriation return timely. I think the argument can be made the other way, because when you look at the code, it does not require that. But this is something that could potentially be fought, and don't really know how it would go. So, if at all possible, file the expatriation return on time. Now, what does this certification test mean? What are you really certifying? First, you need to meet all requirements of this title. That's part of what I quoted from Section 877. This title, like I said before, includes Title 26, which is the Internal Revenue Code. This covers employment taxes, gift taxes, etc., in addition to income taxes, so make sure you're clean everywhere. Interestingly, this does not cover Title 31, specifically covers only Title 26, and Title 31 is where you will find FBAR requirements. So you can have horrible, horrible FBAR problems, but still pass the certification test. That's not necessarily great for you, because it's for other reasons it's not great to have FBAR problems, but it will not affect your certification test. When they say the previous 5 years, what they're looking at, let's say you have a 2018 expatriation, that just means 2013 to 2017, so you take the year of expatriation and then count 5 back from that. And then under penalties of perjury, that means the same thing. It usually means don't lie. And now, I don't know the answers to these questions, but I thought they were worth raising. If anyone out there has any ideas, I would certainly like to hear them. And the questions are, what about if you have entities that you're responsible for? How does that affect your certification test? Let's say you're a partner in a U.S. partnership. Does your certification test include making sure the partnership's tax obligations are met? Have they filed all their returns? All that stuff. What if you're the responsible party for another type of entity, or you have fiduciary responsibilities? I don't actually know for sure how these would go, but I suspect these might play into your personal certification test. Again, probably better safe than sorry on these types of things. So that's the basic idea of what the certification test is and how it works, but we didn't really cover what it really means. So, as you might be guessing, there are a wide range of tax problems you could potentially have, ranging from the very small, which is quite common, to the very, very large, which is not a fun position to be in. So this section of the presentation is kind of to help think about how to look at the bigger stuff and the smaller stuff and what you really need to pay attention to. The general idea is that you need to look at the previous 5 years of your financial life. Make sure you file your income tax or other type of tax returns, or amend them if you filed them and they're wrong in some way. Report all your income accurately. Make sure you file all applicable information returns, pay tax penalties, whatever interest you have due, and when all that's done, you can say that you've met the certification test. And the way you go about this to be certain that you've met the certification test: review your prior 5 years before you expatriate, fix things before you expatriate. And again, this goes back to the question of as of when is the certification made on the certification test? The day you expatriate or the day you file Form 8854. If you follow the IRS position on this at least as much as possible, you're going to want to review your tax returns and fix anything that's wrong with them before you expatriate, so that you can play things safe. Because let's say you don't do it until after you expatriate and the IRS decides that they want to challenge whether you met the certification test because you had these tax problems that existed as of your expatriation date. This could go to tax court, and that's not going to be cheap or easy to deal with, and frankly, no one really wants to be the person who has to challenge the uncertain issue in court. Certainly not when you're trying to make an exit from the U.S. tax system. So the other way to be certain is overfix things. In other words, if you find minor errors on your tax returns, might as well fix those in addition to the big stuff, because that will give you certainty rather than having a little bit of nagging uncertainty following you around. So when you're looking at your tax returns and you find big problems, or you find little problems, or you find both, how do you know what to fix? The big stuff, timbers, this is stuff that's big or bad or both. The decision is easy. You need to fix these. So big, by that I just mean lots of money is at stake. Or if it's bad, that means maybe you missed some kind of information return, required form, something like that. But then the question is, what about toothpicks? What about the really little stuff? And on this one, I tend to always say, think about what you're trying to do here, which is to make a clean exit. A lot of times people do ask, will ignoring the little stuff get you in trouble? And it's a valid question. Can you certify full compliance with all federal tax obligations if you have a normal minor error on your tax return from somewhere in that 5-year period? Or does the certification test only cause you to fail if you have major compliance failures? The IRS has provided no guidance on this. There's no dollar values. There's no specific, make sure you fix these things. So a conservative interpretation would be that they can fail you on the certification test on anything, even the small stuff. But in any case, what you definitely need to fix is if you have big or bad issues. So forms that trigger bad results for failure to file, like unlimited statute of limitations, big civil penalties, criminal prosecution, and of course with these things, I'm talking about information returns. A lot of them carry big penalties, or if you don't file them, it prolongs your statute of limitations indefinitely. Or changes that mean a big tax liability, and here we think about this as $5,000 or more, but very, very often we end up fixing people's returns who have much less than $5,000 in tax due, just because they're taking a conservative approach and they want to make sure that they have absolute certainty that they've passed the certification test. Ultimately, I tend to agree with that approach. A clean exit is going to be more important than money, so fix the little stuff too. Just to give a couple of examples of the different types of, sort of the difference between what's a big problem and what's a small problem. So a timber would be, let's say you're the 100% owner of a foreign corporation, and you've never filed Form 5471, and those of you who are familiar with this form know that if you're the 100% owner of a foreign corporation, you need to be filing this form every year. And if you fail to file this form, it's a $10,000 penalty every year that you fail to file it. And also on top of that, you've never paid any tax on any of the company's income or your distributions. Now, that may be the case that you don't need to pay tax on the company's income, or at least before Section 965 and GILTI were enacted in past years. It's entirely possible that you could have deferred income in the corporation. But usually if you took distributions from it, you would have at least had to report those. So in this situation, this is a pretty big problem. This is a timber because you have 5 years of unfiled information returns, at least $50,000 of potential penalties piled up, and possibly unreported income, possibly a lot of unreported income. And this would be a really bad thing to not fix. If you did not fix this, you could not say that you've passed the certification test. In contrast, you could end up with a toothpick. You review your tax returns very carefully, and you realize that in 1 year, you forgot to report $200 of foreign interest income, but that account was reported on your FBAR and your 8938. So what would the tax on that be? I don't know, a few bucks, not much, maybe $50. So on that one, if you reviewed 5 years of tax returns and all you found was this one little thing, me personally, I'd be tempted to say you're fine. However, when you think about how easy it is to amend a tax return to add in $200 of interest income, and how low cost that amendment would be, and how little tax you're paying, why take the chance? It's extremely simple to fix, and so yeah, it's a tiny issue. You could probably reasonably take the position that you do pass the certification test, but the certification test does require that you pay all tax, you comply with all tax laws, and they don't really give any de minimis numbers. So personally, I would fix the $200 of interest income and sleep soundly at night. And this slide 37 just reiterates what I was saying there. We take a conservative approach on these things. If the IRS published a form for it, so let's say you have to file an 8621 or Form 3520, and you didn't file that form, that's a major failure. Fix that. If there's penalties you have to deal with, or it causes an open statute of limitations, that's pretty major as well. Fix that. I would also add into this, it's not in my bullet points, but if there is income to report that's significant, of course that's going to be pretty major. Fix that. Small omissions, like the $200 of interest income, or deductions that might be disallowed because maybe you weren't really entitled to take that deduction. I don't know. Maybe those wouldn't really change the bottom line much. Might be okay if it got challenged, but since we have no guidance on this, who really knows? So it's probably best to just be absolutely sure. Fix every little thing you find. There are some ideas of a few of the different things you might want to look for. This is not at all an exhaustive list, so don't use this as a checklist. This is just some of the common stuff that we see. Passive foreign investment companies reported on Form 8621. The most common of these is if you owned mutual funds. Very common to have in a foreign investment account. Very often investments are made into mutual funds or ETFs, similar types of funds. Usually those are going to be PFICs, and so you would have needed to file Form 8621 for those. Foreign earned income exclusion. Did you meet the requirements for this? Did you claim this correctly? If you're using the physical presence test, might be a good idea to go back and make sure that you counted your days correctly, kept track of your travel accurately, that kind of thing. Let's see, if you have foreign retirement or other tax-deferred plans, you need to check, are these pension plans because of a treaty? In other words, under the U.S. tax system, will they be treated as pension plans? Will there be some tax deferral? If not, maybe they're foreign trusts. Often the case with foreign retirement accounts, you might need to file Form 3520 and 3520A, or maybe they're ordinary investment accounts because they don't qualify as anything else under U.S. tax law. And in that case, maybe you have foreign retirement accounts that have passive foreign investment companies in them because they have mutual funds. So you might need to file an 8621 because of that. These are things that you would need to take a look at. Other things, gifts and inheritances that you need to report on Form 3520 from foreign persons. Normal estate planning arrangements like trusts, foreign corporations, partnerships, disregarded entities, there's forms for all of those. Foreign financial assets on Form 8938, foreign insurance products on Form 720. This one is not talked about much, but if you paid premiums on a foreign life insurance policy, there's a line for that on Form 720, and you would need to send that in and pay a tiny, tiny amount of tax on the premiums you paid. Now, it might not be necessary to do anything on your certification test. And this is usually going to be the case when your tax returns were prepared by a professional, because I think you have some ground to stand on if you're relying on an expert or a professional who does this for a living. So what you would need to do here is look for your omissions. In other words, is there anything in your financial life that you didn't tell the tax return preparer about, maybe because you didn't think it would be subject to U.S. tax or you didn't know they needed to know? If there's anything like that in your life, then I would not rely on the returns prepared by the professional because they didn't know about everything, so they couldn't have done everything correctly or they couldn't have made sure they were. The other thing is look for the preparer's errors or omissions. If this person is an international tax expert and you have, spoken with them about your foreign accounts and your foreign pensions and the foreign company you set up, and they know about all these things and they've been reporting them year after year, you can probably rely that they have done things correctly. It might not be necessary to hire some other professional to check your first expert's work. So if you have anything where you worked with a tax preparer who normally did domestic work only and you had all kinds of international things, that would be a situation where you might want to get the returns checked because they might not be fully familiar with all the requirements and they might have missed something. But if you don't have either of these situations, if you've told your tax preparer about everything, if they're well qualified to help people in your situation, then it's probably reasonable to say that the tax returns are correct and that you passed the certification test. But most people end up in a situation where they have to fix something. And so when you have to make some fixes to your tax returns and you're in a situation where you'd like to expatriate, so you're kind of, maybe running up against the clock because you'd like to get the expatriation done this year, or, maybe there's going to be some tax due and you have some money concerns there, you have to start to think strategically about how you should go about doing this. And maybe, maybe by filing your amended returns, you'll create a situation where penalties will be assessed. So all of these things are things to think about, and these considerations are all going to be things you think about when you're making a decision about how to fix things. So one way to go about this is to just file your amended tax returns, not go through any special procedure. Just go ahead and send in all your amended returns. If you have omitted information returns, maybe you want to request reasonable cause relief if you think you have a case for reasonable cause. But this is probably going to be the easiest and simplest way. Might not necessarily be the cheapest if penalties get assessed. Streamlined procedure is also an option. This is where you can file 3 years of tax returns with the IRS, and depending on some specific residency criteria, you can either have a somewhat low penalty, 5% of what they call the penalty base, or 0%, and I'm not going to go into what those things are or how they're calculated, but in any case, either you accept a small penalty or a 0 penalty and you get to fix everything and move on with your life. Or potentially one other option is you can let time go by until the really bad stuff is older than the magic 5 years that you have to clean up. This is going to be a really individual choice if you choose to do that, because you have the issue of, let's say you have information returns that were required in a year that you decide to do nothing about and just let the time pass. That will actually, depending on what forms are required and everything, that could put you in the position where you have an unlimited statute of limitations open forever for those bad years. And so that would be a risk that stays with you pretty much for the rest of your life. So that's a pretty big decision to make. And people with low risk tolerance are typically never going to go that route. The last option is about to disappear. So I've put it there, but I put a strike through text on it because there's technically about 2 months left in this process. So I guess if someone really, really wanted to get in and had access to all their information, then they started right now today, they could get everything sent in before, I think it's September 28th, 2018, is going to be the very last day that they will accept submissions under that program. But for the most part, that's not really going to be an option anymore as of a few months ago, because for the most part, it takes longer than that to get all your information together, get all your returns prepared, and get it all sent in. But I guess technically it's still possible. Now, when you're making a decision about what strategy to take when you're going to fix your tax returns, one of the things you're going to think about is time. So the just file strategy is going to be the fastest because you can just send in your returns. You can even estimate any penalties and interest and just pay that up front, and maybe you pay a little extra and you get a refund. If you go that route, it'll be pretty easy to say that you're in full compliance. Streamlined procedure probably takes about the same time as just filing, so it's not necessarily more time consuming, and you're not waiting for the IRS to get back to you and tell you that your streamlined procedure has been accepted, because they don't do that. So it's essentially the same as the just file strategy, but it does only cover 3 years of tax returns, and you need 5 clean years to expatriate. So there's some additional considerations that would go into that option that we'll be talking about. The let time go by, obviously that might be the longest. That just takes however long it takes. And voluntary disclosure, previously I would say was probably the slowest. It takes a while to get all your information in, and then there's a very long processing time. I've seen 3-4 years on those before they're fully closed out. So yeah, if you're hoping to expatriate in 2018 and you think voluntary disclosure is the route for you and you can get your stuff in the next 2 months, just keep that in mind, that your case won't be closed out for at least a couple years if you do that. There's also money considerations to take into account. Which of these paths that we're discussing results in the lowest expected tax penalties and interest? For example, if you were to go under the voluntary disclosure program in the past, you'd be paying a specific percentage of your foreign assets or your unreported assets in penalties, and usually that's going to be very expensive to do that. What's the likelihood that your reasonable cause or non-willful argument will be accepted? In other words, if you're sending in amended returns and they've got information returns attached to them, and you're asking the IRS to please, please, please not assess penalties, what is the likelihood that they'll agree with you versus saying, oh no, you've got no case here and you have to pay a penalty? And what if you disagree and you want to fight it and you want to appeal it, and the time that's involved in that? So these are things to think about as well in selecting a strategy. There's also procedural considerations kind of related to what I was just talking about. How long does it take the IRS to make a reasonable cause determination? In other words, you send in your return with a letter saying, hey, I don't think you should assess a penalty, even though I did this thing you normally assess a penalty for. When do you have certainty that the IRS is going to either assess a penalty or agree with you? Typically, they send you a letter in the mail, but that takes months usually. So again, if you're going this route and you're ultra-conservative and you want to be really sure that everything is fully closed out and taken care of before you expatriate, these types of considerations might prolong that process a little bit if you want to wait till you're absolutely sure it's all good. And then what if you need to file an amended return for a year where the statute of limitations is closed? The IRS automatically assumes that there's a 3-year statute, but there's some things that you might have left off your return that would trigger a 6-year statute. Certain foreign income amounts, things like that. So if you believe you have a 6-year statute, but the IRS believes you have a 3-year statute, and you send in a return and they send you a letter saying, hey, your statute's closed, but you believe it's technically open because you think you meet the 6-year statute, how to navigate through that is something to think about as well. Typically, for me, what I look at is if I know the statute is open, we amend. If it's a situation where the IRS is going to assume the statute is closed, but we think it's a longer statute, we'll file anyway, and the IRS can either send us a letter saying, nope, statute's closed, or they can process the return if they see that it's a 6-year statute. But in either case, in that scenario, at least you've done what you're supposed to do and filed your amended return. Okay. Looks like we have just about enough time to go into the case study. So this will hopefully illustrate some of the judgment calls, some of the considerations that we've been talking about. First couple slides here are just a basic procedure to follow if you're doing a certification test review and you need to make some fixes to the tax returns. First, get a list of all the assets and income items. Second, figure out what all the filing and reporting requirements are for each item. Then you take that list and you check it against the prior 5 years of returns, see if things are done the way you believe they should be or not. Then you make a list or a spreadsheet of all the omitted items and any errors you found. Next, slide 49, figure out the size of the errors and omissions, calculate potential penalties. Then from there, once you know what your penalty risk is and how much tax approximately you're going to owe, you can evaluate the different compliance strategy options. And then lastly, recommend a strategy based on cost, risk tolerance, time considerations. And then when you've decided on something, that is when you fix the returns, send them in, and you can be done with the certification test. So I created a basic fact pattern for us to look at in this case study, and this is just kind of a group of things I see frequently. So it's not necessarily any one client's case, but these are all pretty common errors that I've come across. So let's say that someone has some minor interest income omissions. They didn't report capital gains from some foreign cryptocurrency transactions. In 1 year, they needed to file a Form 5471 Category 3 due to attribution rules. And this would happen where, for instance, a U.S. citizen moves overseas, marries a non-resident. That non-resident starts a foreign corporation, owns it 100%. The U.S. citizen spouse would actually be required to file Category 3, Form 5471 in that year. This is something that, honestly, most people are not going to know and not going to think about. So this could be something that comes up. Also in this fact pattern, let's assume that Form 8621 was omitted for 3 mutual funds held in an investment account, and they filed their FBAR in Form 8938 but left out a couple cryptocurrency accounts that would have needed to be reported on those 2 forms. So here's how I approach these. Slide 51. I make a list of the items on the left side. Across the top, I map out the years, and then all the cells on the page where I have an X, that just means that that item is fine and we don't need to worry about it. So let's say we're looking at 2013. I have $300 of unreported interest income, $22,000 of unreported capital gains, 3 Forms 8621, and 2 accounts that need to be reported on the 8938 and FBAR. In the result row, it says amend. I would definitely want to amend a tax return like this. $22,000 of capital gains, fairly significant, and you have 3 8621s that need to be added to the return and need to make some corrections on the 8938. Again, the FBAR doesn't actually matter for purposes of the certification test, but it matters for other reasons because it carries penalties for not doing it correctly. So it's in my list for that reason. Now we look at 2014. $10 of unreported interest income, $15,000 loss. At this point, you might be wondering, do I really need to fix this? Well, maybe not if you don't want to claim the loss, but you have a Form 5471 under Category 3 because of the attribution rules. That's a pretty major item. And again, the 8621s and fixing the things on the 8938. So that one, again, I would say amend. 2015 starts to look relatively small again, $1,500 of capital gains, missing some 8621s and a couple accounts on an 8938. But because there's the information returns 8938, 8621, we would recommend amend that. 2016, again, $2,500 of interest income, not that huge a deal. Everything's reported on the 8938 and FBAR, and there's just the 3 8621s. This one, again, I would actually say amend. Not that much work to fix it. And let's say we're in 2018, as we are, and this person has not yet filed their 2017 return. It might be an option for them to use the IRS streamline procedure if they qualify for it, meaning they could fix 2014, 15, and 16 under that procedure, which would make the 2014 penalty for Form 5471 go away, or it would make that go away. It would make the 8938 $10,000 penalty go away. They might, depending on what part of the streamline procedure they qualify for, they might need to pay some small penalties, but probably for someone like this, assuming everything is non-willful and they actually do qualify for the streamline procedure, this would be a good approach because it also, under the streamline procedure, covers the FBAR penalties. So streamline procedure would cover the tax years 2014, 15, and 16. FBARs for 2013 would be covered. 2017 you're going to file correctly, so the only thing you have left that would not be covered here is 2013 if you got penalties for not filing the information returns, so it would really just be the 8938 you'd have to worry about. That would be the only potential $10,000 penalty because that year doesn't fit into the streamlined procedure and you can't take that one out. So that year, you might want to just file under the normal procedures, request reasonable cause on the 8938 if you think you qualify for reasonable cause. And if you follow that overall strategy, I would expect that you would only be paying normal penalties and interest. I think actually under the streamlined procedure, it would just be the interest, but I put in normal penalties for those as well, just in case you end up in the streamlined procedure program where you're paying the 5% as opposed to the 0%. So someone in this situation, yeah, they'd have to pay some tax, some interest, maybe a little bit of penalties, but assuming they qualify for the non-willful or the reasonable cause relief, they would actually manage to clean this up without too much of a problem, and then they would be able to expatriate. So that's just an example of a number of problems I see, and as I was talking through it, you can probably see there's a lot of different considerations that go into it. Streamlined procedure covers 3 years, but then it covers all the open years of FBARs, so that's a good strategy. It really depends on the individual situation and the specific problems they have, and you really have to kind of take a holistic view and look at all the moving pieces when you're figuring out how to approach it. Okay, so after doing all this, you might need to adjust your recommendations. If someone has an extremely low risk tolerance, they may opt for a higher cost route if that buys them a lower risk. Or if someone has an extremely low budget, they may be willing to go a slightly lower cost route if the risks are technically higher but very unlikely to actually happen. So this is something, you know, to discuss with clients and see where they fall in this. Which brings us to the end of the presentation, and just a quick disclaimer, this presentation is not legal or tax advice, can't be used to avoid penalties. Please hire someone to help you if you need the help, and thank you very much for listening. I'm going to turn it over to Phil for a couple comments before we close out.
Great, thanks, Deborah. So there you have it. It's not as easy to get out from underneath the U.S. tax system if you really want to. My suggestion, and the way we do it is, as Deborah said, we're pretty conservative about it. It is more important in your life to get out of the United States cleanly and get out of the U.S. tax system cleanly than it is to save a few bucks right now in terms of taxes, penalties, interest, and professional fees. So do it right, do it once, get out, live a happy life. Have a margarita on the beach at sunset. Next month, we're going to have our presentation on August 10, again, noon Pacific time. Deborah, again, is going to be the presenter, and this time she will be talking about Foreign Corporation Information Reporting, specifically Form 5471 and the attribution rules. And she hinted in the presentation just a few minutes ago that the attribution rules can really catch you unawares. You know, she mentioned Category 3. This is an important and weird part of 5471 stuff, and it can mean the difference between filing what you're supposed to or accidentally failing to file what you're supposed to and triggering a $10,000 penalty. Anyway, so join us next month on August 10. If you're not already on the mailing list, please sign up. Go to Hodgen.com/newsletters to sign up. And if you're already on the mailing list, and you probably are because you're listening to this, tell your friends. See you next month. Let's hand it back to Robert.
Thank you, Phil. I'd like to thank Deborah Rudd and everyone attending online. Certificates of completion will be available for download within 3 business days. Thank you all for joining, and have a terrific day.